I want to talk about adjustable rate mortgages next. This is, it's a hot topic because when people hear adjustable rate mortgages, sometimes they have a preconceived notion because they think adjustable rate mortgages is, a bad product or something that a few years ago was, and in a lot of ways it was abused. But there's been a lot of new laws and government oversight over ARMs and changes, and so it may have a negative stigma with you because of something that might have happened to a friend or a family member with some of the the challenging loans that we had back during the bust. But we are seeing more buyers choosing them again to lower their purchase costs, to lower their out-of-pocket costs. And I wanted to give you a little bit of time, Mike, just to talk about the pros and cons of adjustable rate mortgages, and let people know kind of what that is as an option.
Yeah, one of the biggest differences I think now, with the way that the mortgage industry is now compared to, 12, 15 years ago, where we really kind of got in trouble with the adjustable rates. Now, most lenders require that you qualify on the fully amortized rate. So let's just say the initial rate for an easy number is 3%. And over the life of that, the max it could get up to is, we'll just say 8%. Most lenders now will qualify that initial purchase on the 8% rate because it makes them feel comfortable that, hey, if this thing does get to the max rate, as it sits right now, this buyer can still afford that house. So, that's one of the main differences, and a really big difference from when it was back then. Back then it was, hey, this person that can't afford this $500,000 house, let's give them a 3% interest only loan, and it works now, but then when it adjusts, a lot of those same buyers weren't able to keep up with the payments. So that's a huge difference. The adjustable rate product, it can be a good fit for some people, and I think what a lot of people don't know is, it is fixed for a certain period, whether it be 3 years, 5 years, 7 years, 10. Those are the main ones.
And if someone doesn't have an expectation they're going to be in the house that long, that's where it makes sense. If they're going to be in it for, if they're going to be in it a period of time before it resets, then it makes a lot of sense.
Right. Everyone that has ever asked me that question since I've been doing mortgages, is an adjustable rate a good option for me? The first question I always ask them is, how long do you think you're going to live in the house? If you're going to live there for, and for a fact for 2 years, then a 3-year ARM might be a great option for you. You're going to have that low rate. It's going to be fixed for 3 years before it adjusts. You can get out. I've even talked with some people that, they are pretty sure they're only going to be there for 2 years or 3, but not positive. Maybe a 5-year ARM is a good option because it gives them that couple extra years to get out. So there are some instances where it can still be a really good product for you. Again, it could keep the affordability and the payment lower initially in that little bit of time you're there. One of the great things with it too, with the way that our market's been appreciating, if you know for a fact you're not going to be there long, you got that lower rate, lower payment, your property still appreciates, and you can still make a good profit in that time by the time you sell and get out.
Yep, no doubt. So, and I think again, when you look at it from the perspective of the right situation, is it right for everyone? No, definitely not. But it's still a tool. It's still a tool out there for the right people. Just too many people sometimes abuse it, and they would get so attached to the payment and not look at the consequence of this rate could be substantially higher in 5 years if you don't do something between now and then.
Right.
So it really makes sense for a small segment of the home buying audience.
Right. And one thing that I would caution some buyers, especially first time home buyers, there's a lot of credit unions, for instance, that will offer no money down options. But when you dive into those most of the time, not always, but most of the time, that is an adjustable rate.
Yeah.
And because they keep that product in-house, they don't sell it on the open market.
Yeah.
So it allows them to offer kind of a niche product. But where that can get a first-time home buyer in trouble is, if you're putting no money into it, again, not always, but a lot of times it's because you don't have the money to put down.
And then when the repair pops up,
or when that rate does adjust, are you going to be able to afford that higher payment? So that's something that I would caution people, especially first-time home buyers,